Allison Schrager, welcome to The Long-Term Investor.
Thanks for having me.
I am so excited. I told you this before, but my audience should know that you were on a list of people that when I started the show, I was so excited to someday reach out. And I built up the courage recently, but at the time, I had read your book, An Economist Walks into a Brothel, which takes such a unique perspective on risk management. And I was hoping we could just start there and have you share a little bit of what inspired you to take such a unique angle?
Well, I was working at Dimensional Fund Advisors at the time, and we kept hearing from the advisors, they were having problems really communicating risk to their clients. Mainly that, again, if you're investing for the long term, what risk means, how not to look at, some other guy who has a guy who's putting you in a riskier portfolio, so if he's done better this month versus you sort of having this longer term strategy. So I was always kind of had this side writing career and was really inspired by Freakonomics because I felt like it did so much for the economics profession of really helping people understand what economists do. We don't pick stocks, but we think about incentives. So I was thinking the market could use a Freakonomics treatment of finance, or financial economics. I mean, working at Dimensional Fund Advisors was amazing because I had so much access to Bob Merton and Gene Fama and Ken French and David Booth at the time. And I'd learned so much finance from them. Really not just the technologists, really how to think about finance. And I felt like I could be the one to offer that with my writing skills and my financial training. So I had this idea, I was going to Freakonomics, but for finance rather than applied micro. And then it became clear, Steve Levitt had this, library of research papers, and I did not because I hadn't been in academia since grad school. But I did know how to write, so I decided I was going to do reporting instead and found all these stories that sort of illustrate the basic principles of financial economics.
And one of these concepts, though, in the book is that people just so often misunderstand risk to begin with. So what do you feel like are some of the ways that people misunderstand and interpret financial risk?
It's so obvious. It shouldn't be said, but it kind of does. I think people are in complete denial that there's this trade-off for risk and reward. Or it's the more risk you take, the more potential reward. People seem to always think, everything seems to go wrong in finance when people think they can get a bigger than market return and they're in a low risk investment. And I think this is it happens again and again, and it happens to even people who should know a lot better. And so, it sounds like sort of a cop-out to say it, and I should say something more technical or hidden, but it's really just that. I mean, think of Bernie Madoff, think of the mortgage-backed securities, think of Bitcoin. I mean, it's just people thinking, oh, I can beat the market and have a low-risk investment. And as I know people with PhDs in finance, and they get this wrong too.
So you've studied risk and you've shared stories through various industries like Hollywood, like poker playing, like brothels. Mm-hmm. What is an example from your research that you think best illustrates how people should think about financial risk?
Well, I mean, any of them, I think, do illustrate to people. I mean, I think the Hollywood story was really about data and how we need to measure risk to put a price on it. There's nothing wrong with that, but you're always making an estimate. And the problem with it is data gets out of date, data gets stale very fast. So the only thing you can do is use as much data as possible. I mean, this is probably what I learned from Gene Fama, is you're not really making an estimate unless you have 80 years plus of data. I mean, I think we just saw with interest rates, people became very convinced that low interest rates were the new normal because we'd had low interest rates for 20 years. And now we see interest rates are going back to something more historically in line. So I think that's another mistake people make is they get too focused on the short term when really the short term tells us, the long term data is even more stale. But the thing is, the more data you have, the more trends you get. And I think that helps people sort of, think more sort of thoughtfully about how to measure risk. I think from the brothel, I learned that I think, again, risk and reward, that sort of gold, I guess, no arbitrage, as we say in finance, is, you pay for safety. It's just that simple. If you look at price setting in sex work, safety comes at a premium. And that's also true in markets or in anything. I found in any market, we always think about in finance what people pay for safety, and we break that out of a financial price. But it's really true in all pricing. I mean, even you think about if you buy a cheaper washing machine. I mean, there's a higher risk it's going to break down.
Sure.
So, you get a higher quality washing machine, you pay more for it, but there's also less risk, probably a better warranty, all of these things.
self-serving statement. When you hire a trustworthy financial advisor, you remove some of the risk of yourself. But for those of you who are kind of raising an eyebrow and thinking about some of these examples that Allison is sharing, again, I will link to the show notes. I will link in the show notes at thelongterminvestor.com to her book, An Economist Walks into a Brothel. And you mentioned low interest rates, for example. And one of the things I'm really excited to talk to you about is something that a lot of people have opinions on, but they don't really understand, which is our country's debt. And there's this idea that as long as our interest rates are low enough being no one knows what that level is, but then it's not a problem. Let's go big picture, and maybe we'll drill down from there. But how do you think about the U.S. national debt today?
Well, I think it's a problem. So you're right, and this became very popular when everyone was decided higher for longer meant higher forever, although it sounds silly because no financial condition lasts forever.
Sure.
And economists trotted out this formula quite proudly, showing that, if the interest rate on the debt is growing slower than our rate of growth, then you don't need to worry. It's just like financing any investment. If you have a lower interest rate than your rate of return, it's great.
Yep.
But just like in any financial transaction, these are two random variables that are unpredictable and change a lot over time. So the problem is once interest rates go up and your growth rate doesn't go up, you're in trouble. And I think that's what we're starting to see now is that concern, is that our growth rate and interest rate are, not looking to align the way we want to. So that's why it becomes a problem. I mean, that said, I just wrote a column for Bloomberg. I'm very worried about the debt. I don't want to minimize that. But I think we could have worse problems. I was just in Switzerland at Davos, and people there were very concerned in Europe about low growth.
Especially in Germany. Is that the column you're referencing? Yes.
Yes. We have a debt problem. Europe has a growth problem and a little bit of a debt problem. Not Germany, but other countries there. And it is better to have a debt problem than a growth problem. But a debt problem is also still not a good thing to have either.
It's really interesting to hear you put it within that framework. The big number itself, if you're going to address it, probably requires some form of entitlement reform. It's not like we're going to grow our way out of this debt problem. Is that fair?
Yeah, and while I appreciate Doge's efforts, and I appreciate the efforts that we're looking at all forms of spending, I don't understand this critique of, I believe in foreign aid. I just want to put that out there.
Sure.
But people are like, who cares if we're wasting money with certain foreign aid programs? It's a small bit of the budget. It's like, well, it's still part of the budget, and this stuff does add up.
Sure.
So I'm glad we're taking a hard look at government and our spending, but at the end of the day, it is pennies compared to entitlements.
Before I transition to entitlements, because you have a lot of interest in pension, your Substack is very pension focused, so we're definitely going to touch on that. But I want to get your opinion, an economist's opinion, but also someone who has worked in the asset management side on people worry about their portfolios and the U.S. debt. What would you tell someone who owns bonds, owns U.S. bonds of all kinds, treasuries, corporates, whatever? How would you think about the U.S. debt, its absolute level, how we are or aren't addressing it from the perspective of a bond investor?
Well, I would expect yields to go up, so prices to go down. On the other hand, the best way to deal with that might be, as I said, to think about your duration risk and possibly hedge that. So I guess it's the counterintuitive advice to maybe go into long bonds if you have a long-term investment strategy and get serious about inflation protection.
Well, and I think one of the things that people think when they hear the word debt crisis is, and this is just an opinion, and please by all means disagree with it if you do, the crisis would be a big jump in yields. Not that we actually default on our debt, not that we actually don't pay the interest.
I'm not worried that we're going to have a massive default. Well, it depends how you define default.
Well, if the government chooses not to pay because they don't raise a spending limit.
Or we can't. It's not Greece. But I mean, there's different ways you can default. I mean, you can default by, I would call inflation. Letting inflationary pressure be a form of default.
Okay.
So, because it eats away the value of the.
Sure.
So, I mean, in that sense, we do. But yeah, I think I'm not worried about the U.S. just saying, you know what, we can't afford to pay our debts. Too bad, bondholders. We're not Argentina, or they used to be.
Right.
But yeah, I do think that it could take the form of interest rates jumping suddenly, having less control. And then that means our interest payments are higher, and that eats into more of our spending, and that leaves less money available for other services. One thing I've observed is that when you do have a debt problem, there's this hierarchy of who gets paid first, and I think people don't realize that pensioners do get paid first. So they're number one. So we will always make Social Security payments. After that are bondholders, and after that are people who rely on goods and services from the U.S. government. So you can imagine where we're going to fall out if interest rates go up.
And if interest rates go up, there is a way to respond, and it isn't always happy responses, cutting benefits and such. One question
or inflating it away.
Or inflating it away, which is a good tie into something I wanted to touch at least briefly is modern monetary theory, which largely says inflation is the risk of spending, but spending isn't a problem as long as it's going to the right places and doesn't cause too much inflation. How do you feel about that?
I'm not sure what any of that meant. And then, that's not and that's not me being like snarky to you. It's more like me being snarky on modern monetary theory.
Okay. Well, can you dig in a little and help people understand,
I don't understand it at all, because I think it's like a nonsensical argument.
Okay.
Not what you just said, but just the whole philosophy.
Right. So that it's an overfit model, like trying to build a model around what they've seen today.
It also just seems like stunningly ignorant of financial markets. It's just sort of, it seems to assume that, and again, I don't understand it at all, because there's no model.
And to be clear, it's not like you haven't studied and sought to understand it. It's just after having looked at it, it doesn't make sense.
Well, because there's no model. Economists do communicate with models because it's a very sort of clear and unambiguous way to sort of frame your argument. So it's sort of like a lot of these things, a lot of bad economic arguments, which starts with a true observation. We print our own money and, people want to buy our debt. Those things are true. But that doesn't mean that interest rates don't change over time. It doesn't mean we control the whole yield curve. There is a risk premium. There's things like that. And as I said, inflation isn't some trivial thing. I think they believe that we'll get rid of inflation by increasing the tax rate, which is also completely unfeasible. Politically.
Sure.
It's confusing and it's a mess of things that I think people like the sound of. I'm glad, if there's one thing I'm happy about with rising interest rates and the return of inflation, is I like to think we've sort of put this idea to bed.
Well, and part of, I think, why we've experienced such low inflation is that global trade, maybe we've underappreciated the benefits of global trade. And by the time this all comes out and published, we're recording at the beginning of February. Tariffs are in the news. Now that I've sort of time-stamped us, we might as well talk about tariffs. Anything you want to share on your views with tariffs?
Well, I'm not a fan.
You're an economist. Why would you be a fan?
I know. Well, I went to Columbia. We're trained to think about tariffs a very particular way. And I think I'm trying to be open to things. I think we all should be. That maybe I'm a little dogmatic about tariffs being just the most evil thing you could have in economics. And, I'm not sure. My training really got me thinking about a country like China being in the World Trade System that does manipulate their currency. We are very dependent on them for a lot of goods and that we are highly dependent on. Apparently during the pandemic, we discovered they make 90% of the ingredients for antibiotics. I think it's a problem. And I do think tariffs might be more effective than sanctions. I think we did just see from the theatrics over the weekend that, they could be useful leverage for some political things. So I don't love them, but I'm trying to be more open-minded by their use in more limited ways. That said, I felt like under the Biden administration, this philosophy of we are going to use tariffs for global diplomacy became popular. And was it Jake Sullivan talked about this walled garden where we would be thinking about them very thoughtfully. But I think you also, as we're now seeing with Trump, once you open the door, it is hard to keep that in the walled garden. So I'm trying to be less dogmatic about it and have more mixed feelings about, all right, in this situation, maybe, we could think about tariffs, small tariffs in some ways being somewhat useful, but it's hard for me to get on board with high tariffs that are broad.
Just to sort of put something in my own words and not necessarily say this is what you're saying, but is it a little bit like when I studied economics and finance in school, there was no behavioral finance aspect of it, and everyone was a rational investor. And so tariffs, we know from an economics standpoint, in the textbook, that's not a rational choice, but if there are less rational or people are cheating the system.
It can be a rational choice. If, for instance, the Chinese government is so determined to keep their manufacturing going, and they would eat the cost of the tariff, then
okay, sure.
I think more I worry about, if we use them as a tool of diplomacy, I don't doubt, say Mexico, Canada, Europe, that they are rational actors and they will do what's in their economic best interest and they won't do crazy retaliatory tariffs. You never know, but sure. I think they are.
Good base case.
Yeah. But I'm not entirely sure about China's motivations in China being fully rational in their economic policy. So that's something as well, if we're thinking about them as a way to use political tool, something to think about.
very interesting. Let's refocus back on the U.S. I'd mentioned earlier Social Security. I want to be very open-ended here and just get your general thoughts when you have to think about or talk about Social Security. What are the risks you see? What are the ways that those risks should be framed in terms of risk reward, and what are actions you feel like need to be happening?
Well, like I was saying, I think one of the ways we get risk wrong is we get confused about safety. And Social Security, when I think about it, in the role it plays in people's retirement portfolios. So I think one thing we get wrong when we think about entitlements is it's part of a larger retirement system. Like it's part of, when people retire, they have different sources of income. Social Security, they've got money from their 401ks, maybe they have money from other forms of saving, maybe they have an old DB plan lying around. So Social Security is supposed to be the foundation, sort of the risk-free source of income that you can count on no matter what. So the danger is with entitlements is everyone knows we're not going to have the revenues to fully cover Social Security, so people start thinking of it as a risky stream of income when it really isn't. As I said, I think we'll default on our debt before we default on Social Security. That's just my assumption. Maybe I'm wrong. So Social Security is going to be there. But people have this sort of weird cognitive dissonance with it, which is, I don't know if it's going to be there for me. My mother's in her 70s, she says that. And I'm like, they're not going to cut your bet. Anyway.
Right. They're not going to, politically, if you're over the age of, I'm just going to randomly say 55, something's going to be there for you.
Yeah, exactly. I think it's going to be there for everyone. But in some form.
Sure.
It's supposed to be that foundation, but people assign a risk on it. But at the same time, they're also incredibly reluctant to have any sort of reform, even if the reform would hit people under 40.
Right.
Like people see it as this thing, they're very upset about it, yet they also don't want anything done. Like one thing that I find interesting is a lot of sort of new Republicans, the new right, the new economic right, are like, Donald Trump was really smart because he realized Social Security reform, entitlement reform was unpopular, so he stopped doing it, unlike Romney and
Sure.
Paul Ryan. I'm like, well, it's always, I could have told you it's unpopular in 2010. No one likes having to pay higher taxes and getting lower benefits, which is what it's going to entail. There's really just how the math works, and everyone knows it.
Yep.
So saying I'm not going to do this unpopular thing anyway it needs to be done, I don't think is some political revelation. Or it certainly isn't, say, leadership. I mean, I don't know. Maybe I've heard theory, I know Scott Bessent, the Treasury Secretary, is very serious about debt reduction. I was on a panel. I don't know how credible this is. Last year at Davos with Kevin Roberts, was part of 2025, and he was quite adamant that Donald Trump was going to take on entitlement reform, largely because he is a lame duck president and he wants his legacy to. He seems to be wanting to fix big problems. So maybe we will get something. My advice for entitlement reform is to think of it holistically as a system. So if you're going to reform Social Security, you should also reform defined contribution 401k market too, so they move together, so people don't have this complete perceived drop in income or just increase in taxes, but it's offset in other ways.
Well, and it is useful for people to see how other countries are doing it. I believe Canada has a program that they're very proud of and such. I know that was actually a panel that I watched of yours in Davos. But there's a lot of countries like that.
Although they all have problems.
There is no perfect answer.
Well, everyone has an aging population. Or any country that has a mature pension system has an aging population.
Right. And you need population growth, whether that's through immigration without being political. You need population growth and your population's aging otherwise. Immigration is a tool to sort of fix that.
Exactly, because pay-as-you-go pensions, and most countries have some form of that, which is younger people pay for older people, is sort of how we've created the foundation of risk-free income. And so, I mean, that is a bit of a time bomb. So everyone's dealing with that to some extent.
Well, the one thing that struck me and was disappointing about the campaign trail is that our debt wasn't an issue at all, which is probably why no one's going to address the entitlements to begin with. But when you think in your background of pensions, I mean, beyond Social Security, what is it that you see about pensions and the retirement system beyond Social Security that people ought to be thinking about?
I think they need to be thinking about income in retirement. I'm very bullish on our 401k market. I think it's actually done a pretty good job. There's certainly things that could be improved, but people have more money for retirement than ever before. I mean, most people are surprised by that because I think everyone has this romantic notion that everyone used to have a defined benefit plan. If they did, odds are they weren't participating in it. I think only 30% of people were active participants at any one time. So before it was worse, and somehow we got through it. I mean, granted, people didn't live as long, they didn't have the same long-term care needs, but somehow people managed to survive. So I think the defined contribution move definitely expanded access, expanded retirement wealth. So I think that's great. I think we really, we're pretty close, especially with the latest Secure Acts, to expanding access to plans even for small employers. I think we've done a pretty good job at getting people to save more, and that's kind of the hard part. But there is also the challenge of, okay, you have this pile of money and now you're retired, and what do you do with it? And I don't think we've thought very carefully or thoughtfully about that, particularly that the whole investment industry is very geared towards, are you saving enough and what's your return this year? And what's the pile of money you're going to have on day one, but not how are you actually going to deal with that money into retirement?
Well, and what's interesting to me is that if you make decisions, when you manage a retirement plan, you have a fiduciary duty to like the average participant. And someone might ask, well, who's the average participant? But when I think of what the average American is, they would benefit from the guaranteed income that something like an annuity might bring. I think the challenge for a lot of advisors is that they don't, for advisors who traditionally would say that doesn't maximize wealth, which is a true statement.
But it's a different problem.
Yes, and you're not solving for the average person isn't solving for wealth maximization. They're solving for living a life of dignity and respect. And
but no one realizes this.
Correct.
And this is partially because of the wealth management industry, and I don't blame them for this. This is sort of, we had a wealth management industry that was geared towards rich people, and then we sort of handed them the 401k problem, so they did what they knew how to do.
Right. Well, and I think advisors in the wealth management industry often don't get paid on annuities, and as a result, they don't like them. And now they were high cost. They're actually coming down, and I think some of the research around annuities is interesting. The more those costs come down because they don't have to pay a kickback to like an insurance broker.
Also, interest rates are higher.
That's true. Interest rates being low is not great for the annuity market.
Well, and it's also, I mean, I've been thinking a lot about how we can make annuities more accessible.
Yes.
Like, it didn't really work well in the UK, but the government used to run a website with like live auction prices so you could comparison shop. And because it was a government-run website, people trusted that these insurers were well-regulated and well-financed. And so, I mean, I feel like we could layer that into 401k markets. Like when you are looking to retire, you can have, you know, access to sort of different income options. I think, and there's aspects of the 401k market, you know, with record keepers not wanting to share annuity prices or sort of being tied to a particular annuity provider that make it unattractive.
Right.
So I think we can make the annuity, I mean, there is actually a thriving annuity market in Chile. I mean, Chile has its issues for sure, but I think by and large it is a very well-constructed retirement program. And part of it is people are also very geared towards annuitization early. They understand they're going to annuitize. When they're in their 50s, they start talking to annuity providers. So they're conditioned to it. As opposed to, right now we're thinking, oh, we'll just glop it on at the ends, which is a problem as well because they're not hedged for that risk. Because, you know, what if the market's down the day you have to bank your annuity? What if there's a spike in interest rates? So the prices, I mean, they're not very well hedged for that risk and they're not conditioned to it. So even if we do offer people annuities, I don't think, people are not going to like it.
Right. And the average person, though, people who are in tune with financial matters aren't going to like it. Those who know nothing about their finances might say, okay, sounds great. So I'm going to get my paycheck every 2 weeks like I'm used to. And that's probably fine. It
is, but people are also very conditioned to being like, I have this nest egg I've been saving my whole life. I'm just going to sign it over to an insurance company.
That's a good point.
I think that's a hard emotionally for people. I can see why. Honestly, I would find it hard too, and I know better. But on the other hand, if we condition people to have them think about this is income, not wealth, I think it would be a little bit easier.
I like that. Now, you are referencing some global trends, and I mentioned you're recently back from Davos, the World Economic Forum. Give our viewers, our listeners, a little sense of what were the big themes there, and what is it when people are going there, the idea sharing and seeing these other global perspectives that you find value in?
Well, you heard two things a lot, Trump, and Draghi report. So it was, what is Trump going to mean? What is he going to do? I think there was definitely a sense that, you know, the first Trump victory, you know, everyone could think, oh, that was sort of an anomaly. You know, who knows even what he really wants or what he's thinking. But I think now winning again, and not only winning again, but winning with a fairly coherent worldview and an economic view is like, this is a thing. And, you know, even if you think that tariffs are a valuable negotiation tool, it's different than the sort of post-war idea that we all come together in these big institutions and hash out something that's in our global interest. I said I did my graduate training at Columbia where I felt very strongly that bilateral trade deals are never as good as multilateral trade deals. In fact, they're just as bad as autarky. That might be a little extreme, but this is definitely, like, even if Trump is purely using tariffs as leverage, I don't think he is, but even if he is, then that is a big break. So I think there was that feeling of, wow, this is a new era. On the other hand, I think people were surprisingly positive about Trump. Anyway, I guess they're like globalists who like international institutions, of, well, maybe some of our institutions are ripe for reform and maybe we should shake things up. And the other thing, big word, was regulation. The idea that we're all over-regulated, that we really need to...
We all globally, not just the U.S.
U.S., particularly Europe.
Well, sure,
Europe
yeah.
is very obsessed with the fact that maybe they're over-regulated. Although, they want growth. They're realizing they need growth. They're aging faster than we are. They have even bigger entitlements. But I feel like their excessive regulation is sort of a symptom of a larger mentality that they have. Like, regulations reduce risk. I mean, that's what's nice about them, but you pay for that with lower growth. Sure. And in 2008, I remember I was 2009, I was at the OECD, and they had some party or an event, and I'm not sure why I was invited, because when I worked there, they never invited me to anything. There was like, sit in the corner, American. But for some reason, I was there. And someone gave a speech saying, financial crisis proves this European way of like steady, slower growth is better than this brash American boom and bust. And I kind of like wanted to say this last trip, like, well, how do you like that? How did that go for you? Because, there's a trade-off between, I said, it's the same theme. It's true in growth. It's true in financial markets. There's no reward without taking on more risk. So I think while Europeans talk a good game about maybe lowering regulations, doing away with regulations, they have a lot of excessive regulations. I was talking to a German woman who was saying there's some study that business owners spend 3/4 of their times with regulatory compliance for ESG.
Oh, wow.
Because they not only have German ESG requirements, but European.
Oh my gosh.
So there's probably a lot of low-hanging fruit for them, but there's also has to be more comfort with risk and less predictability, which I don't see them being comfortable with.
It's really fascinating. And you had recently written something about more risk, less reward, and how just like in general political considerations are maybe overtaking economic ones. And I hear some undertones in some of the things you've said throughout our conversation, but what do you think are the biggest risks we should be thinking about with this new landscape or this idea of the current landscape?
Well, I think we're entering a more volatile period for a lot of reasons. And that particular column you're thinking of I wrote for Bloomberg was actually fragmentation, because I mentioned I was on a panel about it. I was trying to figure out what it meant.
I will link her panel to fragmentation in the show notes at thelongterminvestor.com. You did a wonderful job, by the way.
Thank you. So, but it is an idea that it's, if we're trading less or trading more, not with everyone, but with, whoever we've struck deals with, the flip side of trade is capital flows. So that just means more fragmented capital flows or, smaller. Because, one thing that's been wonderful about the last 200 years is capital is flowing everywhere. And that was a result of, innovations in markets and just it's an appetite. So it meant a lot of people got a lot richer in developing countries, but it also meant diversification. I mean, this is the one free lunch in finance is diversification, where if you diversify well, you can have more reward and less risk. So now we're going to pull back on diversification. That just means we're going to have more concentrated capital flows, and that just means more risk for less reward. But also, we also have a more concentrated economy in the tech sector. And I don't know if there's necessarily anything we want or should do about that. But that is just because where we are in the innovative cycle.
How does this, if I'm trying to oversimplify and think of, okay, earnings are what? If you're a stock investor, you just want earnings to grow, broadly speaking, preferably where you own the most exposure. But when capital flows are less, how does that impact or are hurt? How does that impact a company's ability to grow earnings, or how does it impact? And I know that, in a model sense, not a predictive sense.
Well, I mean, it depends on the company and what their business is.
Fair enough. So if you're a manufacturer, that's going to cause a lot of problems, where if you're selling effectively,
well, yeah, I mean, you're
property,
probably going to pay more for inputs, things like that. You have fewer sources for goods and services, so for the inputs that you need. But I think of it more of the problem for investors. right, is that you're just invested in fewer places. And that just means more concentration. In addition to concentration we already have from tech. So that just means more volatility for less reward.
Yeah. I think people underweight the importance of that less volatility, especially in the US where it's just done so well.
We're just so used to low volatility.
Yeah, I mean, 2024, I don't think I saw more than a couple days where it moved 2% up or down. And the diversification, you're using the word more return for less risk. I mean, I tend to think of it of more return for the amount of risk you're taking.
Yeah.
Because, if you were in all US, yes, you earned more return. But there's also these decade-plus periods where S&P 500 lost to cash that people forget about, and they couldn't possibly have sat through that patiently.
Yeah, I look at my portfolio, and I'm just like, wow, my heavy U.S. funds did so well. I'm still have most of my money in a very diversified, big global fund that's in everything.
Sure.
And I'm like, it has not done nearly as well, half as well.
But it still has a good return. Decent.
It's a good return, but I look at it and I'm like, should I keep putting money in this? And I'm like, yes, because I believe in this.
So you're human too. You have emotions as well.
I do. I try not to look at my portfolio very much for that reason, but I'm just like, I believe in this. I'm sticking with it.
I like that.
I think obviously my concentration to the more heavy U.S. funds has ticked up just because it's returned more. And I can't say I've rebalanced either, so I'm at fault too.
So let's go a little bit more micro and think about people's personal finances since we're sort of talking about it. With your study of risk, with your unique way of addressing risk, what do you feel like if people can only take away one thing in which they can apply how to think about the risks around them to their personal finances, what would that be?
I mean, I would think about what your goals are, what you need, and take as much risk as you need to get there. People either sort of expect to be in something low risk, even personally, and still expect things to happen. Or sometimes people aren't good at calibrating their risks or taking the right risks. So I would just be thoughtful about what it is you want, what it is you need, and what risks you need to take to get there.
And so if thinking go as broad as you want or as narrow as you want, of all the risks that you think about on a regular basis, one is one risk that you are very comfortable taking, but then what is also one risk you'd avoid at all costs, personally?
I'm afraid of physical risks. I don't ski.
Okay.
I think skiing's insane. And they do people put slippery sticks on their feet and go down a mountain. It's just crazy. I understand there's some fun involved and social.
I'm a big skier, but I've been doing it forever. If I were an adult, I would never learn to ski. I'm 40, I would never go take my first ski lesson today at age 40. That seems insane for some.
Yeah, I mean, I grew up skiing too, but
Oh, but you won't do it now.
I was never that into it, I think.
Okay.
But I think I'm very comfortable, I think, with professional and financial risk.
Okay.
I mean, not entirely. I'm in index funds. I'm not in some triple levered beta fund or something. But yeah, I think I take a lot of risks both financially and professionally.
I love all the things that you put out there on the pension stuff specifically, but how you are risk framed and doing it in a unique way. And again, to those of you watching, to those of you listening, you go to thelongterminvestor.com. I'm going to put a ton of Allison's work up there. You should also subscribe to her Substack, Known Unknowns. You can find her as a Bloomberg Opinion columnist. Your stuff is everywhere, and this has been such a treat to have you. Thank you so much for joining me here today.
It's my pleasure. Thank you.